Did you know that during the 2008 financial crisis, the S&P P500 lost over 56% of its value? It then took more than 4 years just to get back to even. Or how about this? In the 2022 bear market, a simple buy and hold strategy in a total market index fund would have seen you lose nearly 25% of your money. Now, you're probably thinking, that's the risk you take for long-term gains. And for the most part, you're right. But what if you could see the storm coming? Not to abandon the market forever, but to just step aside for a little while? To protect your capital and live to invest another day. This is the core of a method we call the 3-signal rebalance. This isn't about timing the market in the classic reckless sense. It's about having a disciplined, rules-based system that tells you when the macroeconomic environment has become so hostile that it's time to temporarily move your index fund investments into something safer. Because the biggest threat to your wealth isn't a temporary downturn, it's a catastrophic, unrecoverable loss. And the math is brutal. If you lose 50%, you need 100% gain just to break even. The goal of this strategy is to avoid that deep hole in the first place. So, what are these 3 signals? They are clear, quantifiable indicators based on the most powerful forces that drive market cycles: the Federal Reserve, market momentum, and broad economic health. Think of them as 3 alarm bells. When 1 rings, you pay attention. When 2 ring, you get cautious. But when all 3 are screaming at once, history shows it's a signal you cannot afford to ignore. Let's break them down, starting with the most powerful force in finance, the Federal Reserve. Signal number 1 is an inverted yield curve. This sounds complex, but the concept is simple. Normally, you get a higher interest rate for lending your money for a longer period. A 10-year US Treasury bond should yield more than a 2-year bond. That's a normal upward-sloping yield curve. An inversion is when that relationship flips. When the 2-year yield is higher than the 10-year yield, it means investors are so pessimistic about the near-term economy that they're piling into long-term bonds, driving those long-term yields down. It's the bond market's way of predicting a recession. And it's scarily accurate. Since 1955, every single US recession has been preceded by an inverted yield curve. It's not a perfect timing tool. The recession can start 6 to 24 months after the inversion. But as a warning signal for the market, it's one of the best we have. For instance, the yield curve inverted in 2006, well before the 2008 crisis. It inverted again in 2009, before the 2020 COVID crash. And it inverted sharply in 2022, right before the bear market. When you see a sustained inversion, that's your first red flag. Signal number 2 is the 200-day moving average. This is your objective measure of market momentum. It's simply the average closing price of an index, like the S&P P500, over the last 200 days. When the current price is above this line, the long-term trend is generally up. When the price dips and stays below this line, the trend has turned negative. We're not talking about a 1-day spike below the line. We're talking about a decisive, sustained break. Think of it like this. The 200-day moving average is the market's center of gravity. Price can wander above and below it, but when it breaks significantly and can't get back above, gravity is winning. During the 2008 crash, the S&P P500 broke below its 200-day moving average in early 2008 and never recovered until well into 2009. In 2022, the same thing happened. The break below this key level confirmed that the bullish trend was over and a bear market had begun. This is your second red flag, a clear visual confirmation that the market's engine is stalling. Signal number 3 is rising unemployment claims. This one is about the real economy, not just financial markets. We're not looking at the headline unemployment rate, which is a lagging indicator. We're looking at the weekly report on initial jobless claims, the number of people newly filing for unemployment benefits. When the economy is healthy, this number is low and stable. But when companies start to see demand fall, the first thing they do is stop hiring, and then they start laying people off. A sustained, significant rise in weekly jobless claims is a real-time indicator that corporate America is battening down the hatches. It tells you that the earnings which ultimately drive stock prices are about to come under severe pressure. Let's go back to 2008. Jobless claims started climbing steadily in the spring and exploded higher after the Lehman Brothers collapse. In 2020, they literally went vertical, skyrocketing to millions per week. In 2022, while the absolute numbers were low, they began a clear and persistent upward trend throughout the second half of the year, signaling that the Fed's interest rate hikes were starting to bite. This is your third red flag, proof that the financial stress is translating into Main Street pain. Now, any one of these signals on its own can be a false alarm. The yield curve can invert briefly without a recession. The market can dip below its 200-day MA and then bounce back. A single bad jobs report can be a blip. The magic and the statistical edge comes when all three signals line up. When the yield curve is inverted, the market is below its 200-day moving average. And jobless claims are trending decisively higher. You have a confirmed risk-off environment. This is the three-signal rebalance. Rebalance trigger. So what do you actually do? You don't sell everything and go to cash in a panic. You execute a disciplined rebalance. You move a significant portion, let's say 50% to 80% of your equity index fund holdings into ultra-safe assets like short-term treasury bills or a money market fund. You are not trying to pick the bottom. You are acknowledging that the environment has changed and that the odds of further losses are high. You are prioritizing capital preservation over potential gains. Then you wait. You wait for the signals to reverse. You don't need to catch the exact bottom. You just need to see the environment improve. You wait for the yield curve to normalize. You wait for the market to climb back and hold above its 200-day moving average. You wait for jobless claims to peak and start trending back down. When two of these three signals have turned positive again, that's your all clear to move your money back into the market. You will have missed the very bottom, but you will have also missed the catastrophic middle. You will have avoided the deepest part of the drawdown and preserved your capital to deploy when the sun is starting to shine again. This is not a strategy for day trading. This is a strategic, maybe once every few years portfolio adjustment designed to sidestep the worst bear markets. It requires patience and the emotional fortitude to not be a hero when all the warning lights are flashing red. The three-signal rebalance is your systematic way of being fearful when others are greedy, and greedy only when the storm has truly passed. If this framework makes you rethink what's possible with a disciplined, rules-based approach to investing, then you need to be here with us. We break down complex financial strategies into actionable plans every single week. Don't leave your financial future to chance. Hit that subscribe button and ring the notification bell, because your next edge in the market is just one video away.